Welcome to the Deep Dive, your go-to source for cutting through the noise and extracting essential insights for the most impactful research. Today we're embarking on a journey into the often bewildering world of financial markets. From sudden crashes that erase trillions to the dizzying heights of speculative bubbles, it often feels like we're caught in an unpredictable storm. You just have to think back to the sharp market dives and skyrocketing volatility of 2011, which cost investors over $3 trillion. Or the Great Recession, which for many really felt like the second worst depression in modern history. It's enough to leave anyone bewildered, maybe even terrified. Our mission today is clear: to pull back the curtain. We've taken a stack of critical sources, primarily drawing from David Dreman's Contrarian Investment Strategies, to unpack the deep psychological biases that lead us astray. We're going to reveal the surprising realities behind seemingly rational investor behavior, challenge some long-held financial theories, expose the weaknesses in expert forecasting, and ultimately uncover a proven path to navigating this often alien world of investing. Our goal, as always, is to give you a shortcut to being truly well-informed, equipped with insights and tools to protect and hopefully grow your capital.
It's really fascinating because it's more than just economics, isn't it? We're delving into human nature itself and how our inherent psychological makeup, manifests in market behavior. David Dreman, who people often call the dean of contrarians, has really pioneered integrating these behavioral insights into investment strategy. His revised edition of Contrarian Investment Strategies is just a treasure trove, showing us how cutting-edge psychology, including newer fields like effect theory and neuroeconomics, can directly inform smarter decisions. So this deep dive will hopefully guide you through understanding these powerful, often hidden forces at play.
Right. So our journey begins not with balance sheets, but with the human mind. Let's start in part one. What state-of-the-art psychology shows us? Specifically, let's look at Planet of the Bubbles, a recurring cycle of euphoria and panic. You might think modern markets are uniquely prone to wild swings, but our sources reveal that this human tendency towards, speculative frenzy is far from new. It's a historical constant, almost a timeless allure of easy wealth that keeps drawing people in again and again.
Absolutely. History offers countless lessons, if only we'd, heed them. Consider the infamous Dutch tulip mania of the 1630s, where single tulip bulbs were trading for more than houses. It sounds absurd now, but it happened. Or think about the English South Sea bubble around 1720, or the French Mississippi bubble at the same time. Fortunes were made and lost in the blink of an eye.
And these weren't just quaint historical footnotes, were they? Our sources directly connect these early manias to much more recent events. Things like the dot-com bubble from, 1996 to 2000, and the devastating financial crisis of 2007, 2008. The common thread is really striking. Whether it's sophisticated French nobles from the 18th century or, contemporary investment bankers today, the belief that enormous wealth is within their grasp just fuels these manias. It's an intoxicating idea.
And a dangerous one.
The scale of these modern events really puts things in perspective, too.
Oh, definitely. During the 2007-2008 crash, financial stocks plummeted an astonishing 83% in just 21 months. That's eerily similar to the 89% drop in the Dow during the Great Depression, but it happened in about half the time.
Wow.
The credit freeze was so severe that Jean-Claude Trichet, who was president of the European Central Bank then, called it the worst since the Dark Ages. Think about that comparison. Similarly, the dot-com bubble saw the Nasdaq Q100 index soar 717% before crashing 83% to its low in October 2002. Just wiped out fortunes and all those once hyped companies.
What's truly remarkable is how hard it seems to be to resist these powerful market forces, even for people who should know better. Dreman himself shares a personal story, admits he got caught up in the same foolishness during the 1966-1969 go-go bubble. And this was despite his academic understanding of historical manias. It really highlights how deeply ingrained this tendency is.
It does. Even independent, skeptical thinkers often get swept up. There's this thing called the greater fool theory. People know prices are preposterous, but they think things would get madder still, hoping they can sell to an even greater fool before the crash.
Right. So this brings us to a crucial question. Why do even seemingly rational individuals succumb to this?
Well, there's a great quote from a British MP bankrupted by the South Sea bubble in 1720. He perfectly captured it. He lamented, "I said, indeed, that ruin must soon come upon us, but I own it came too much sooner than I expected."
So close, yet so far.
Exactly. It speaks to the insidious power of these cycles, and it leads us directly into the next topic, the perils of affect, when emotions override logic.
Okay, affect. So here's where the role of our emotions really takes center stage. we need to forget the image of the purely rational economic actor, right? Affect theory introduces this powerful emotional system that operates much faster than our rational analytical one. It's not about deep thought, it's about immediate gut-level reactions.
And that speed is its insidious power. Affect can override even professional training and experience. It helps explain both extreme stock mispricing and bubbles and that rapid, almost instantaneous shift from euphoria to panic. Just think about the instant reaction you get when contemplating a big investment game. That's positive affect working.
Or the dread of a wipeout in a favorite stock.
Right, that's negative affect. This emotional system acts almost instantly, while our rational system takes far longer to process all the facts, all the data.
Our sources highlight 4 key forms of affect that frequently lead investors astray. The first one is insensitivity to probability. This sounds like, but we just ignore the actual odds.
Pretty much. It's where a strong emotional meaning attached to a potential outcome, like that major investment gain, makes us surprisingly insensitive to its actual likelihood. We just feel it's going to happen regardless of the odds. Research has shown people are moved more by the possibility of a strong positive outcome than its actual probability. For instance, studies found people might pay up to, I think it was 1,000 times more for the same lottery odds if they feel they're going to win. It doesn't matter if the probability is 1 in 10,000 or 1 in 10 million. The feeling overrides the math.
Wow.
And this applies directly to stock manias. Speculators pay vastly more than a stock's real value. During the dot-com bubble, the Nasdaq Q100 had a PE multiple exceeding 200 times earnings at its peak. Historically, growth stocks were maybe 25, 35 times. Emotions, clearly not probability, were driving prices.
We saw this vividly with companies like AOL Time Warner back in the dot-com era. Initially priced at $100, the AOL part of the company's value just plummeted by about 90%, right? Due to competition, slowing growth, overstated earnings.
All the rational reasons were there.
Exactly. But investors completely ignored that rational analysis, swept up by this powerful, positive, effective image. And another prime example, eToys.com. At its peak, it had a market value of, what, $10.7 billion.
More than triple Toys R Us.
Which had actual stores and sales. eToys had less than 1% of its sales, was operating at a loss, limited management.
But analysts and investors, as the source says, did not process the information because of the very powerful, positive, effective image. The allure of the next big thing was just too strong for objective assessment.
Okay, so that's insensitivity to probability. What's the second form of affect?
The second is negatively correlated judgments of risk and benefit. This really challenges the traditional efficient market hypothesis, or EMH, which assumes higher risk equals higher perceived reward. Affect theory, however, has discovered the opposite is often true psychologically. The greater the actual risk, the smaller the perceived gain. And conversely, the smaller the perceived risk, the greater the perceived gain.
So it turns modern risk theory completely upside down.
Pretty much, in terms of how our intuition works.
So if we like an idea or a stock, we intuitively judge its risk as low. And if we dislike it, we judge its risk as high, regardless of the reality.
That's the gist. In finance, this meant stocks perceived as good were judged to have higher returns and low risk, while bad stocks were perceived as low return and high risk. Completely backwards sometimes. Think about oil exploration companies after the BP oil spill in 2010. They plummeted. They were perceived as facing prohibitive cleanup costs, long-term drilling bans.
Negative affect was overwhelming.
Exactly. Yet within a year, deep water drilling resumed. The cost turned out to be manageable, and some of those very stocks more than doubled. Affect led to a massive overreaction based on perceived risk, not the actual underlying situation.
That's a perfect illustration. What about the other two forms?
The third form of effect is durability bias. This means we tend to overestimate how long our emotional reactions to future events will last. This bias contributes to those prolonged market overreactions we see.
We think the pain or the euphoria will last forever.
Right. And the fourth is temporal construal. This is our tendency to represent near-term events in vivid, concrete detail, like focusing intensely on the latest quarterly earnings report, while distant events are seen more abstractly, like long-term strategy. This leads to misjudgments because we prioritize those immediate market signals over crucial but less vivid long-term fundamentals.
So what all this means is that when affect takes over, our rational analysis just breaks down. Security analysis, looking at the numbers, is generally effective only within maybe 25-35% of a stock's fundamental value. But in bubbles, PE ratios can explode from 10 to 100 or even 1,000 times earnings. At those levels, fundamental analysis becomes completely useless, doesn't it?
Utterly useless. Our sources emphasize that when this happens, Analysts and money managers actually abandon the rational analytic approach. They shift over to the experiential system where affect easily overwhelms our rational analytic processes. As Dreman puts it, you didn't need a fancy financial GPS to see how far off course pricing was. A sextant would have worked just as fine. It was that obvious if you weren't caught in the emotional storm.
Okay, so affect is powerful, but it's not the only psychological trap.
Right. Not at all. This brings us neatly to treacherous shortcuts in decision-making, heuristics that lead investors astray. This highlights how we constantly use mental shortcuts or heuristics. They're typically flawless for everyday decisions like, crossing the street.
Right, you don't do a full risk analysis every time.
Exactly. But these same shortcuts lead to systematic mistakes and complex financial judgments. Despite what some economic theories assume, people are definitely not really good intuitive statisticians.
One of the most common pitfalls mentioned is the availability heuristic. Can you unpack that?
Sure. This causes us to assess the frequency or probability of an event by how easily instances come to mind. For example, we might overestimate the likelihood of shark attacks because they're so dramatic and heavily reported, even though falling airplane parts are statistically more dangerous but less memorable.
So in investing, maybe we overemphasize recent dramatic stock gains because they're so vivid and easily recalled.
Precisely. This heuristic involves two key errors: saliency, where distinctly good or bad events are disproportionately recalled, and recency, where we overweight recent events, ignoring longer-term trends or base rates.
The IPO mania from 1996 to 2000 seems like a perfect illustration of this.
Absolutely perfect. Historically, IPOs were offered at a small discount, maybe 10% or so, but during the internet bubble, the average IPO premium at the close of the first day's trading soared to a staggering 90%.
90% on day one.
Yeah. And for .com specifically, it hit 135%. This enormous recent appreciation, combined with its saliency everyone was talking about, it was enough to attract droves of investors, despite often terrible underlying fundamentals.
But the long-term reality was devastatingly different.
Completely different. A study looking at 1970 to 1990 found that IPOs returned just 5% annually compared to 10.8% for the S&P 500. Over those 21 years, the S&P 500 returned 762% versus only 179% for IPOs. A huge difference.
And many of these .com IPOs were basically just ideas, right? 95% dream and 5% product.
That's how Dreman describes them. No earnings, going public at 20 to 100 times their book value. And predictably, by 2002, those .com IPOs from 1997-2000 saw an average decline of a startling 97% from their high to their low price. Just catastrophic for many.
So this really underscores the importance of those psychological guidelines you mentioned earlier, 2A and 2B.
Exactly. They emphasize, don't rely solely on the case rate, those exciting recent returns. Always consider the base rate, the prior probabilities, the long-term returns, because wildly high or low returns are likely abnormal. Your best defense against recency and saliency is to keep your eye on the longer term, grounding your decisions in historical averages, not just the latest hype.
Okay, availability is one heuristic. What about representativeness?
The representativeness heuristic. This makes us judge something by how much it resembles a stereotype, often causing us to ignore prior probabilities or base rates. A classic example. After the 1987 crash, many investors fled to cash because it seemed eerily similar to 1929 in their minds. They represented it as the start of another Great Depression.
But they ignore the fact that crashes don't always lead to depressions, right? The economy often bounces back.
Exactly. They ignored the base rate probability. Similarly, during the 2007-2008 panic, investors dumped strong industrial stocks, assuming they'd be obliterated, just like the financial stocks, because the situation felt similar. But many of those industrials were actually enormously undervalued, like oil, at $68 in June 2009, which then appreciated 40% in 2 years. Misjudgment based on faulty representation.
We also fall victim to something called the law of small numbers.
Yes, that's treating initial flash economic statistics, which are, frequently revised later as street gospel. It leads to investors dancing on tiptoe after every little piece of trivial information.
Instead of sitting on their hands like the chess player.
Right. The source mentions a world champion chess player whose advice to avoid bad moves was simple: sit on your hands. Yet in finance, investors often do the exact opposite, reacting impulsively. We also see this over-reliance on experts. Think of Elaine Garzarelli. Her brilliant call predicting the 1987 crash completely overshadowed her otherwise mixed track record. People kept following her despite inconsistent advice later on because she represented someone who called the crash.
And this all ties into that fundamental principle of regression to the mean, doesn't it?
It absolutely does. The simple idea that extreme returns, whether high or low, are usually outliers. Prices tend to revert to their average over time. But investors and even experts often overlook this. They prefer to explain sharp deviations with some new, spurious theory like, this time it's different, rather than acknowledging a likely return to historical norms.
And all this is happening in an environment with, well, too much information, or TMI.
Yes, the role of TMI. Paradoxically, today's absolute torrent of data does not equate to better decisions or increased accuracy. In fact, it can often lead to overconfidence without better results. Our sources use a great historical parallel. London soothsayers back in 1524 predicted a massive Thames flood based on massive astrological evidence. It caused a mass exodus from the city.
Did the flood happen?
Nope. They later blamed slight errors in their calculations and, believe it or not, repredicted it for 1624. It just shows how information overload, even when it seems authoritative, can lead to widespread error if it's not processed critically and objectively.
We also apparently engage in doing heuristic math, or input-output matching. What's that about?
It's the intuitive belief that psychological inputs, like, say, strong sales growth, should perfectly correlate with outputs, like consistently rising earnings. Smooth, predictable patterns feel better. So investors often have more confidence in a company showing consistent 10% growth year after year than one with maybe more volatile 15% average growth, even if the latter's total return is potentially higher.
Because the consistency feels safer, more predictable.
Exactly. This drives investors to play the fads or fashions that are currently performing smoothly, demanding immediate consistent success, rather than focusing on potentially lumpier but ultimately stronger fundamentals over time.
And this feeds into anchoring bias.
Right. Anchoring bias is where investors drop the anchors far too close to the stock's current price, which leads to missed opportunities or holding on too long. Consider Cascade Communications, described as a leader in PC networking. It was grossly overvalued at $91, but investors anchored to that high price couldn't believe it could go much lower. It eventually dropped all the way to $22.
Wow.
That inability to conceive of prices deviating significantly from the recent anchor prevents proper, objective valuation and decision-making.
Okay, the final bias in this section is hindsight bias, the I knew it all along effect.
Precisely. The tendency to believe that past mistakes were obvious in retrospect. This severely impairs our ability to actually learn from experience because we misremember how uncertain things felt at the time. After the 2007-2008 housing crash, for example, many people blame themselves, thinking the bubble was so clear.
But was it really that clear to everyone before it burst?
Our sources argue no. The sheer extent of the leverage in the entire financial system and just how enormously overrated subprime mortgages were by Moody's, Standard & Poor's, and Fitch. These things were not widely known or understood until much later, often after extensive House and Senate committee investigations in 2009-2010. What seems blindingly obvious now was far, far murkier at the time. Hindsight makes us feel smarter than we were.
Okay, so given the power of all these psychological biases, affect, heuristics, hindsight, how did traditional economic theories, the ones assuming perfect rationality, ever gain such a strong foothold?
That's the perfect transition question. It naturally ushers us into part 2. The New Dark Ages, and specifically Chapter 4, Conquistadors and Tweed Jackets, the rise and fall of the efficient market hypothesis, EMH.
Right, the EMH. It's truly remarkable how, back in the mid-20th century, this powerful new theory emerged from academia. It came armed with high-level mathematics and statistics, and it really aimed to revolutionize Wall Street thinking.
The revolution arguably began with the random walk hypothesis, or RWH. It actually dates back to Louis Bachelier's work in the early 20th century, observing that commodity prices seemed to move randomly. This idea was rediscovered in the 1960s when studies found stock price movements look similar to Brownian motion, that random jiggling of particles.
Meaning past prices offer no clue for future movements.
That was the conclusion. RWH posits that stock price history contains zero information you can use to beat a simple buy-and-hold strategy. Essentially, the market has no memory. This led to what Dreman calls an academic blitzkrieg, with influential studies firmly supporting the random walk and seemingly discrediting technical analysis looking for patterns in charts entirely.
And EMH didn't stop there, did it? It also challenged fundamental analysis, the deep dive into a company's sales, earnings, financials.
That's right. Even early SEC studies, way back from 1927-1935, had found that investment companies generally failed to perform better than an index of leading common stocks. So the EMH argument became, if technical analysis is useless because prices are random and fundamental analysis yields no consistent advantage because information is already priced in, what's left for the active investor to actually do?
Which leads us to Philly APM, the capital asset pricing model.
Exactly. CPM entered the scene, often described as a younger brother of EMH. CPM provided a new definition of risk. It defined risk solely as volatility, measured by a metric called beta. The overall market, like the S&P 500, was assigned a beta of 1. A stock with a higher beta was considered higher risk and theoretically should offer higher returns to compensate.
And the implication was?
The implication was to just buy and hold a diversified portfolio, likely an index fund. Frequent trading only increased commissions without reliably increasing returns. Any managers who did outperform were dismissed as being just plain lucky. The semi-strong form of EMH, which stated that no professional investor could consistently beat the market using publicly available information, became the widely accepted doctrine.
And the academic influence was just immense, wasn't it?
Huge. Professor Eugene Fama, a leading EMH advocate at the University of Chicago, was incredibly influential. He continually reviewed literature supporting EMH, creating a climate where, as the book puts it, no graduate student would dare send off a paper criticizing the hypothesis.
Wow.
This new faith of EMH, much like Pizarro's conquistadors with their technological edge, effectively subdued millions of investors with its awesome statistics. Trillions of dollars flowed into index funds based on this thinking. It really was a seemingly unassailable fortress of financial theory.
But even the strongest fortresses eventually show cracks. Which brings us to Chapter 5. It's only a flesh wound. The cracks in EMH's foundation. Despite its dominance, EMH struggled to explain some really glaring market phenomena, didn't it?
It really did. Like, why do investors, even professionals, collectively seem to underperform the market for decades? Why is professional opinion so consistently wrong at crucial market turning points? And if investors are supposed to be unfailingly rational, how could euphoria and panic prevail so often? Crucially, how could two severe bubbles and crashes, the dot-com bust, 1996-2002, and the financial crisis, 2003-2009, happen within just years of each other, despite legions of professionals supposedly following EMH principles? These were hard questions for the theory.
The first major, visible blow to EMH's credibility came with the 1987 crash, didn't it? And the spectacular failure of portfolio insurance.
Yes, that was a huge one. Portfolio insurance was this strategy based on the sophisticated Black-Scholes options pricing model that promised downside protection while still allowing upside gains. Seemed like the holy grail.
And I remember you mentioned attending a conference just months before.
Right. Dreman recounts attending a conference at a bastion of EMH, the University of Rochester, in June 1987. He spoke about the possibility of a market crash, and the academics present basically scoffed almost to a man and snickered at the idea.
And then just months later,
October 19th, 1987, Black Monday, the Dow plummeted 22.6% in a single day, and the portfolio insurance theory blew apart completely.
what was the fatal flaw? Why did it fail so badly?
The problem was its rigid, formula-driven nature in a real-world crisis. The insurers were forced by their models to sell stock index futures as the market fell to hedge their positions. But as they sold, liquidity, the availability of buyers dried up completely. Crucially, major brokerage houses and S&P futures traders knew the formulas the insurers were using.
Oh, so they could front-run them.
Effectively, yes. They knew how much selling was coming and shorted futures ahead of the portfolio insurers, which just exacerbated the death spiral and drove prices down even further faster. It was a catastrophic demonstration that real-world markets don't always behave as elegantly or efficiently as mathematical models predict, especially under stress.
You'd think that would have been a wake-up call, but the lessons weren't fully absorbed, were they?
Apparently not. Just a few years later, we saw the long-term capital management LTCM debacle unfold between 1994 and 1998. This wasn't just any hedge fund. It was the absolute creme de la creme. Led by Nobel laureates Robert Merton and Myron Scholes, key figures behind the Black-Scholes model itself.
The inventors of the model that underpinned portfolio insurance.
Exactly. They grew assets to over $100 billion and had derivatives positions totaling around $1 trillion. Their core belief, straight from EMH-GAPM thinking, was that volatility was the sole measure of risk and that it remained stable over time, making market movements mathematically predictable. They considered leverage, borrowing heavily, as almost inconsequential.
Famous last words in finance, usually. So what happened?
The collapse was spectacular. When the Asian economies melted down in 1997 and then Russia defaulted on its debt in 1998, a global flight to safety occurred. LTCM's complex arbitrage trades, which bet on tiny spreads between supposedly related securities, widened dramatically instead of converging. And the market volatility they had bet against by shorting it skyrocketed. Their capital just evaporated, plunging from around $5 billion to just hundreds of millions in only 4 months. It was on the brink of collapsing the global financial system.
And the key lesson was?
The crucial lesson, as our sources highlight again, was that the two risks not even considered punctuation marks by EMH theorists, leverage and liquidity, came to the forefront just as they had done in the 1987 crash. It exposed a fundamental, devastating blind spot in EMH's simplified understanding of real-world risk.
And the hits just kept on coming for EMH. The 2007-2008 housing bubble and crash was another stark reminder.
Absolutely. Despite the clear warning signs to some, Fed Chairman Greenspan and Bernanke continued to issue these reassuring statements. Bernanke famously stated in March 2007 that the subprime mortgage problem was likely to be contained.
Which turned out to be spectacularly wrong.
Completely wrong. Housing prices dropped steadily, the mortgage market disintegrated, and liquidity froze solid. The ABX-HEBBB index, which tracked subprime mortgage securities supposedly with low volatility, sank into a black hole, dropping almost 98%. Even supposedly safe AAA-rated subprime securities fell 70% or more.
And the root cause, once again.
Again, as the analysis points out, leverage and lack of liquidity. The same culprits, playing out on an even larger, more systemic scale.
These repeated failures, these crashes and near collapses, they really started to unravel the EMH narrative, didn't they?
They did. Which leads us into Chapter 6, Efficient Markets and Ptolemaic Epicycles, the Unraveling. The analogy here is to the ancient Ptolemaic system of astronomy, which grew increasingly complex, adding epicycles, circles within circles, to try and make the theory fit the observed movements of planets, rather than abandoning the flawed core idea that the Earth was the center.
So EMH proponents started adding complexity to save their theory.
Essentially, yes, trying to patch it up to explain away the accumulating contradictory evidence from the real world.
And here's a stunning turn. Eugene Fama himself, the leading EMH advocate, played a role in this unraveling.
In a way, yes. In a 1996 paper co-authored with Kenneth French, Fama effectively refuted another written by academics who thought to defend beta, the cornerstone of CAPM. They stated flatly that beta cannot save the capital asset pricing model. Fama later even declared beta is dead.
Wow. The high priest declaring the main god dead.
Pretty much. This was a monumental shift, a dethroning, because beta determined how trillions of dollars are invested by pension funds, endowments, and other major institutions. Yet, inertia is powerful. Even after this, Morningstar's popular 5-star mutual fund rating, which so many investors followed, still relied on Fama's now problematic 3-factor model for its risk measurements, illustrating how deeply entrenched these ideas were, even after being discredited by their originators.
So if KPM and beta failed, what did the EMH proponents replace it with? More epicycles.
Exactly. After abandoning CAPM, they moved to new, more complex factor models, 3-factor, 4-factor, 5-factor models. They were still trying to prove a reliable correlation between some measure of risk, usually involving volatility in some form, and return.
But did these new models actually work better?
Our sources are critical. They note these new models are built in the identical fashion as CAPM, still fundamentally attempting to show that higher volatility equals higher return. The bigger problem is they cannot prove that. Any other models they put forth actually work, rather than simply being chance correlations found by data mining. Milton Friedman's warning rings true here. Correlation is far removed from causation. Dreman humorously mentions the old hemline indicator, which suggested roaring markets when hemlines were high a correlation, perhaps, but certainly not causation.
Right.
Fama's own 1998 survey essentially admitted defeat, stating that all the volatility-based models tested up to that point are incomplete descriptions of average returns. The epicycles weren't saving the core theory.
So the Achilles heel of EMH, then, seems to be its flawed statistics and untested assumptions.
Precisely. The original EMH studies from the 1960s and early 70s, the ones that supposedly proved no one could consistently beat the market, used statistical tools for risk adjustment that were simply too imprecise. For instance, Michael Jensen's famous 1968 study found only 1 out of 115 mutual fund managers showed statistically significant superior performance after risk adjustment. But the methodology itself made it extremely difficult to show superior manager performance when it existed. It set an almost impossibly high bar.
And what about that core assumption that new information is immediately and correctly reflected in prices?
That was the vital pillar of EMH, but it was an assumption that was never really thoroughly tested in the way you might think. Researchers primarily tested for a reaction in the market to news, not the correctness or the completeness of that reaction over time.
So just showing the market moved wasn't proof it moved efficiently.
Exactly. Dreman uses the analogy. It's almost equivalent to saying that if a man can jog, he's capable of winning the 100-meter sprint at the Olympic Games. A reaction doesn't prove correctness or optimal speed.
There was a specific study mentioned, the stock split fallacy.
Yes, a landmark 1969 EMH study by Fama, Fisher, Jensen, and Roll, often called FFJR. They looked at stock splits and concluded that prices don't systematically move up significantly after the split is announced, supposedly proving market efficiency. The news was already priced in before the announcement.
But there was a flaw.
A significant one. A closer look at their own chart in the paper showed that the steepest run-up in prices actually occurred in the 2 to 4 months after the split announcement date. The researchers themselves even admitted in a footnote that the exact announcement date wasn't actually in their database for many companies. If it had been, and they'd measured from that point, the conclusion would likely have been the opposite, that the market reacted slowly and inefficiently upwards after the news.
And later studies confirmed this inefficiency.
Yes, replication studies decades later, using better data, found significant excess returns of 3.4% to 12% in the years following stock splits, directly contradicting the original EMH conclusion. Furthermore, EMH suggested that in mergers and tender offers, stock prices adjust very quickly. Maybe a 15% increase around the announcement captures most of the value. Yet other studies show the total increase for target shareholders averaged closer to 30%, indicating the market's initial pricing reaction was far too low and therefore inefficient.
We also see clear evidence against efficiency in how markets react to dividend changes, right?
Absolutely. A 1994 study by Michael Caridi, Thaler, and Womack found very clear patterns. Stocks significantly underperformed the market by 11–15% over the 1 to 3 years after a dividend cut was announced. Conversely, stocks significantly outperformed by 7.5–24% over the 1 to 3 years after a dividend increase was announced. This is clear evidence of market inefficiency, a slow, drawn-out reaction to significant new information, not the instantaneous, correct adjustment predicted by EMH.
So wrapping up part 2, the sources paint a picture of a crisis of modern economics.
They do. Modern economics, in its admirable quest to be rigorous like the physical sciences, heavily adopted mathematics, but it often built its elegant theories on unrealistic assumptions about human behavior, particularly the assumption of absolute consistent rationality. EMH's reliance on this almost omniscient rationality is deeply problematic. Yet economists often defended it because, as one book candidly stated, to introduce a more realistic assumption would make economic theory very difficult.
Convenience over reality.
It can seem that way sometimes. As journalist John Cassidy observed, many complex new mathematical theories have been discredited with no agreement on what should replace them. Understanding EMH and its flaws is absolutely crucial for investors because even though it's largely a failing hypothesis, blindly following its dictates can lead to deadly results, as the crash has demonstrated.
Okay, so if our psychological biases are strong, and traditional rational theories like EMH have been, well, pretty thoroughly debunked by reality, what does that mean for all the experts out there trying to predict the market's future?
That's the perfect lead-in to part 3, flawed forecasting and poor investment returns. We kick this off with Chapter 7, Wall Street's addiction to forecasting, the overconfidence problem. And it really is a paradox. As the amount of information available increases, experts' confidence in their predictions often rises significantly, but their actual accuracy barely budges, or sometimes even gets worse.
There was a study mentioned about clinical psychologists.
Yes, a fascinating psychological study. With a low level of information about a patient, the psychologist expected to be correct in their diagnosis about 33% of the time. Their actual accuracy was only 26%. Okay, not great. But when the amount of information they received was increased fourfold, their confidence shot up to 53%. They felt much more certain.
But their accuracy?
Their actual accuracy only nudged up slightly, to 28%. More information led to much more confidence, but virtually no improvement in predictive accuracy. This highlights a critical point, especially relevant to finance. When predictability is inherently low, like with stock market movements or complex geopolitical events, experts are often more prone to overconfidence than novices, precisely because they have access to so much rich, detailed information that feels like it should lead to better predictions.
And this wrong in-depth problem seems rampant on Wall Street.
Oh, absolutely. Wall Street pours immense resources into research. Think about it. Thousands upon thousands of reports generated daily. Washington and international listening posts. They even hire former corporate executives hoping for the real scoop. Endless conferences, data feeds.
All this effort should lead to great results, shouldn't it?
You'd think so. Yet surveys looking at Wall Street experts' best stock picks consistently found dismal results. One study through 1993 found only 25% actually outperformed the market. More recent data cited from Advisor Perspective, covering in the 10 years up to 2007, showed that simple S&P indices outperformed the average expert stock picks in 6 out of 9 industry electors. This surprisingly high level of error, sometimes approaching a 90% failure rate for forecasts to be accurate, indicates there are systematic and predictable forces working against unwary investors who rely solely on these expert predictions.
Which brings us to another key psychological guideline, number 10.
Yes. Tread carefully with current investment methods. Our limitations in processing complex information prevent their successful use by most of us. It's a caution against assuming that complexity and expertise automatically equal accuracy. And this sets the stage perfectly for examining the unreliable art of earnings estimates, which are really at the heart of so much security analysis today.
All right, Chapter 8. How big a long shot will you play? The unreliable art of earnings estimates. Anyone who watches financial TV sees how analysts are often treated like stars, right? These well-dressed men and women who seem to know everything about the markets. Their upgrades and downgrades can literally move stocks instantly.
They have that immediate impact.
But the question our source poses is critical. Are CNBC, Bloomberg, or other media giving us any more consistently accurate information than the Weather Channel? Are these forecasts actually reliable?
Well, the answer became disturbingly clear, especially after the dot-com collapse. Regulatory investigations by the SEC and state attorneys general around 2003 really unveiled conflicts of interest. They found that the supposed Chinese walls meant to separate investment banking, which brings in huge fees, and stock research, which is meant to be objective, had basically come tumbling down.
So the research wasn't independent.
Often, far from it. There was a mad scramble among investment banks for lucrative IPO underwriting fees during the bubble. This led analysts to be pressured, sometimes implicitly, sometimes explicitly, into giving favorable ratings to weak companies that were banking clients or potential clients. Publicly, analysts would heap praise, calling stocks screaming buys, while privately, in internal emails uncovered by investigators, they were mocking the very same companies as pigs, junk, or crap.
That's incredible. There were specific examples.
Oh, yes. Henry Blodgett at Merrill Lynch famously gave a buy rating on GoTo.com, later Overture, then flippantly admitted in an email there was nothing interesting about the stock except for Merrill's potential banking fees. That kind of blatant conflict was apparently widespread.
And the incentives were just completely misaligned, weren't they?
Totally misaligned. Brokerage firms often tied analyst bonuses directly to the amount of commission revenue their recommendations generated for the sales force. One firm's system gave a buy recommendation 130 points, but a sell recommendation only 60 points. And crucially, there were no points added for accuracy. It incentivized optimism, not correctness.
And companies could push back against negative reports.
Yes, companies would often retaliate when analysts write negative reports. The book cites examples like Citicorp, Bank One, and Nations Bank allegedly stopping business with investment firms whose analysts dared to criticize them. So analysts faced pressure from their own firms and from the companies they covered to stay positive.
So with all those pressures and conflicts, how accurate were the earnings forecasts themselves?
The picture painted by the data is bleak. A large database study covering over 216,000 consensus earnings estimates over 38 years yielded some truly stark findings about their accuracy. Get this. Less than 30% of the consensus estimates were within plus minus 5% of the actual reported earnings. And that plus minus 5% range is what most professionals consider absolutely essential for their valuation models to work properly.
Less than 30% accuracy within the essential range.
Yes. Only 47% were within plus minus 10%, a range many pros find far too large to be useful, and only 58% were within plus minus 15%. The conclusion is unavoidable. Analyst earning estimates, even those prepared just 3 months in advance of the reporting date, are notoriously inaccurate. Relying heavily on the means, as Dreman puts it, you are making a bet with the odds heavily against you.
This leads directly to Psychological Guideline 13, doesn't it?
It does. Most current security analysis requires a precision in analyst estimates that is impossible to provide. Avoid methods that demand this level of accuracy. It also exposes what psychologists call the illusion of validity and the danger of the inside view bias.
Explain those.
The illusion of validity is our tendency to maintain high confidence in our predictions, even when they know the hit rate is not very high. Analysts might know forecasts are often wrong, but they remain confident in their own current forecast. And this is often fueled by the inside view.
Inside view versus outside view.
Right. The inside view focuses intensely on the unique details, the specific circumstances of the case at hand, this company, this product launch, this management team. This often leads to over-optimism because you focus on the best-case scenario for this unique situation. The outside view, in contrast, deliberately ignores those specific details and instead asks, what happened in similar situations in the past? It focuses on the statistics and outcomes of a reference class of comparable cases.
So it grounds the forecast in historical reality.
Exactly. Daniel Kahneman tells a great story about planning a curriculum project. An expert on the team estimated it would take 18-30 months, the inside view, focused on their specific plan. But when Kahneman asked him about similar curriculum projects undertaken by other teams in the past, the outside view, the expert reluctantly admitted that about 40% were never even completed, and those that were finished took, on average, 7 to 10 years, not months.
Wow. That's a huge difference.
Massive. The expert, using the inside view, was wildly over-optimistic about his own project's chances, and we saw this writ large during the financial crisis. Large banks, investment bankers, the Fed, the Treasury, they all made dozens of reassuring statements, relying on an inside view of why their situation was different, why this time it was contained, ignoring the clear outside view provided by the history of past financial meltdowns.
Okay, let's shift gears slightly to Chapter 9. Nasty Surprises in Neuroeconomics, the brain's reaction to market events. The chapter starts by reminding us that history is replete with unheeded alarm bells and dreadful surprises, like the German embassy warning before the Lusitania sinking in 1915, which was largely ignored.
Or President Lyndon Johnson exaggerating the Gulf of Tonkin incident in 1964 to escalate the Vietnam War, an example of reacting disproportionately to potentially exaggerated information. The lesson is we often ignore clear warnings or overreact to others, setting ourselves up for market shocks.
And this ties into the predictable impact of earnings surprises on stock prices.
Yes, very directly. A study looked at the 1,500 largest CompuStat companies over 152 quarters, measuring how their stock prices reacted to earnings surprises relative to the analyst consensus estimates. They found consistent patterns based on whether a stock was favored or out of favor. For best stocks, those already popular high PE stocks favored by the market, a positive earnings surprise often does little more than confirm their expectations. High expectations were already baked in, so the price might rise only moderately.
But what about a negative surprise for a favored stock?
Ah, that's where things get dramatic. A negative surprise for a favored stock acts as an event trigger. It shatters the positive image. Investors are shaken by the realization that this could happen to a best stock. The disappointment leads to a dramatic price drop. Amgen is cited as an example. Its stock plunged after an unexpected FDA mandate, even though the drug in question remained profitable. It wasn't just the financial impact. The stock lost its favorite stock luster, its positive affect, and the price suffered disproportionately.
And conversely, for the worst stocks, the unloved ones.
For worst stocks, those out-of-favor, low PE companies, a positive earnings surprise causes a significant price rise. Why? Because it directly challenges the prevailing low expectations and negative sentiment. It forces a reappraisal upwards.
This predictable behavior sounds like something neuroscience could shed light on.
And it does. This is where neuroeconomics comes in, offering fascinating insights by literally looking inside the brain during these events. Using fMRI scanners, neuroeconomists measure brain activity, particularly in areas related to reward processing, and they focus on the role of neurotransmitters like dopamine.
Dopamine, the feel-good chemical.
Right, but it's more nuanced. Dopamine is crucial for signaling prediction errors, the difference between what we expect and what we actually get. When expected rewards don't materialize, like that negative earnings surprise for a favored stock you were counting on, dopamine levels in key brain regions dries up. This neural signal corresponds to the feeling of disappointment and leads to that significant, immediate, and then continuing drop in price as investors react to that negative feeling.
Our brains are literally wired to react this way to surprises.
Exactly. Furthermore, studies show the intensity of regret, losing a likely bet, or rejoicing, winning an unlikely bet, correlates with the perceived probabilities, and different brain regions show distinct activation patterns with these emotions. It confirms that these predictable market behaviors aren't just abstract theories, they're deeply rooted in our shared neurobiology.
So, Psychological Guideline 21 becomes critically important here, doesn't it?
Absolutely. It states, favored stocks underperform the market, while out-of-favor companies outperform the market, but the reappraisal often happens slowly, even glacially. This predictable pattern of overreaction and slow correction, heavily influenced by affect and our neuroeconomic responses, is what our sources identify as the potential key to large and consistent profits for investors who understand and exploit it.
Okay, this understanding that markets systematically overreact in predictable ways due to psychology leads us directly into part 4, doesn't it? Market overreaction, the new investment paradigm.
Precisely. Our discussion has laid a strong foundation now for introducing the investor overreaction hypothesis, or IOH, as the core of Dreman's contrarian approach. This new paradigm posits that investors consistently overreact to events, both good and bad news, and this overreaction leads to predictable price reversals over time as the initial emotional response fades and fundamentals reassert themselves. Affect and those cognitive heuristics we discussed are the primary drivers.
And the IOH stands in direct opposition to the efficient market hypothesis.
Directly. It challenges EMH at the core, rejecting its assumptions of rational pricing and instantaneous, correct adjustments to news. In fact, the conclusions drawn from IOH are often diametrically opposite to those from EMH. It's a completely different way of looking at how markets work.
So what are the key predictions made by the investor overreaction hypothesis?
The IOH makes several clear, testable predictions. First, best stocks. Those popular stocks with high valuation multiples like high-priced earnings, PE, price-to-cash flow, PCF, or price-to-book value, PBV ratios, will consistently underperform the overall market over time. Second, conversely, worst stocks, those unpopular out-of-favor stocks with low PE, PCF, or PBV ratios, or often a high dividend yield, will consistently outperform the market over time.
Why? What's the underlying mechanism?
The hypothesis is that investors become over-optimistic about the prospects of best stocks, driving their prices too high, and they become too pessimistic about worse stocks, pushing their prices too low. This sets the stage for predictable outcomes, which leads to the third prediction. Earnings surprises will systematically favor the worst stocks because it's easier to beat overly pessimistic expectations than it is to meet or exceed already euphoric ones. And fourth, both favored and out-of-favor stocks will eventually regress to the mean over time, meaning their extreme valuations, high or low, tend to normalize as the initial overreaction fades.
Now, this sounds completely counterintuitive if you've been raised on traditional finance theory, like Satan worship, as the book puts it.
Yes, it can feel that way. The idea that the investments everyone thinks are best turn out to be bad, and the ones everyone dismisses as worst turn out to be good, goes against the grain. But the crucial point is the proof offered. Decades of consistent data showing contrarian strategies outperforming.
Like the low PE strategy.
Exactly. The low PE strategy is perhaps the oldest and best documented contrarian approach. Early studies back in the 1960s by Nicholson and later work by McWilliams and Breen showed that stocks with low PE ratios were distinctly superior investments. And intriguingly, even staunch EMH advocates like Fama and French in their influential work in the 1990s essentially discovered that these contrarian value strategies worked and that beta, their previous measure of risk, did not explain returns well. They attributed the outperformance to a value premium, a risk factor, but the practical result was the same. Low valuation stocks beat high valuation stocks.
What does the long-term performance data actually show?
The performance data presented is really compelling. A major study tracked the performance of the Compostat 1500 large and mid-cap U.S. stocks over 41 years, ending in 2010. Stocks were divided into 5 groups, quintiles, based on 4 different value measures. The results were striking. The lowest PE group averaged a 15.2% annual return over those 41 years.
Compared to the market?
Compared to the market's overall long-term rate of return, which is typically cited as around 9.9% since the mid-1920s. So a huge outperformance. Similarly, the group with the lowest price-to-book value averaged over 14% annually, and the group with the lowest price-to-cash flow also averaged 14% annually. Basically, these simple contrarian strategies outperformed the long-term rate of return of common stocks 37 to 54% consistently over this very long period.
And crucially, they held up during bad times.
Yes, that's key. These strategies stood the test of time, performing relatively well through both the dot-com crash and the severe 2007-2008 meltdown. They helped investors avoid total devastation or major loss of capital compared to chasing high-flying growth stocks. Conversely, the favored stocks, those in the highest PE, PCF, or PBV groups, significantly underperformed the market. The example given is stark. $10,000 invested in the highest PE group grew to only $259,000 over the 41 years, less than 30% of the $913,000 the overall market would have returned. Buying popular, expensive stocks was a losing game long term.
Okay, the evidence seems strong. So how do we put this into practice? Let's move to Chapter 11, Profiting from Investors' Overreactions, Practical Contrarian Strategies. The low price-to-earnings PE strategy is the cornerstone, right? How is it calculated?
It's straightforward. You use the company's reported earnings, usually before non-recurring gains or losses for the last 12 months, and divide that into the current stock price. You're looking for stocks where this ratio is low compared to the market or its peers. This strategy has a long track record, proven to outperform in both up and down markets going back to at least the mid-1930s.
And the 41-year study confirmed its power.
Absolutely. As we said, the lowest PE group averaged 15.2% annually over those 41 years ending 2010. That significantly beat the market's 11.6% average return during that specific period and crushed the highest PE group's 8.3% average. It almost doubled the annual return of the most expensive, highest PE stocks. That's a massive difference compounded over time.
And there's a benefit in bear markets, too.
Yes, a key benefit is that cheaper, low PE stocks often pay higher dividends. Those dividend payments provide crucial income and a cushion, helping these portfolios hold up better and provide protection during bear markets when capital gains disappear.
And interestingly, the strategy seems to favor a buy and hold approach, not constant trading.
That's another powerful finding. Even when looking at rolling 5-year holding periods within that 41-year study, the low PE portfolio still provided by far the highest annual returns at 15.2%. This compared favorably to 9.4% for high PE stocks and 12.0% for the market over those same 5-year stretches. It clearly demonstrates that unnecessary trading, chasing short-term performance, often just reduces returns due to costs and taxes, which leads perfectly to Psychological Guideline 24. Avoid unnecessary trading. The costs can lower your returns over time. Buy and hold strategies provide well above market returns for years. Patience pays off with contrarian investing.
Okay, so PE is one core strategy. What about the others mentioned? Price to cash flow and price to book.
Yes. Beyond just PE, other contrarian strategies based on different valuation metrics are also highly effective. The low price to cash flow strategy consistently worked well, providing returns around 14.1% annually in the study. Cash flow can sometimes be seen as a cleaner measure of profitability than reported earnings. And the low price to book value strategy, which compares the stock price to the company's net asset value on its balance sheet, was a longtime favorite of the legendary value investor Benjamin Graham. It also showed strong performance, averaging around 14.3% annually.
So multiple ways to identify value.
Exactly. The key takeaway is that all three of these core value strategies handily beat the market and sharply outperform the best stocks in each case over the long run. Plus, they generally offer significantly higher dividend yields, which adds substantially to the total return, especially during market downturns or periods of low growth.
There's also a high-yield strategy, focusing just on dividends.
Yes, the high dividend yield strategy. This approach involves buying stocks that pay a high dividend relative to their share price. This strategy also outperformed the market significantly by 105% over the 41 years when including reinvested dividends. It offers several benefits. Regular income, the potential for rising dividends over time if the company performs well, capital appreciation potential as the stock potentially gets re-rated, and often it provides the best protection in most bear markets because of the income stream. Although it wasn't entirely foolproof, the 2007-2008 bear market saw many high-yielding stocks, especially financials, forced to cut their dividends. But generally, high yield offers a defensive quality.
Okay, so we have these core strategies based on ratios, but are there other key indicators investors should look for when selecting specific contrarian stocks? It can't just be the numbers, right?
Right, the ratios are the starting point, the screener. But successful contrarian investing requires looking beyond just the quantitative measures. Several qualitative indicators are vital. First, Dreman emphasizes focusing on large and medium-sized companies. Why? Because they generally offer more staying power and have much lower failure rates than smaller, more speculative firms. Turnarounds in these larger, established companies like Ford, bouncing back after the 2009 crisis, are also more noticeable and tend to attract investor attention eventually.
So more resilience makes sense. What else?
Second, look for a strong financial position. This is absolutely crucial, especially for companies that are currently out of favor. You need to ensure they have the liquidity to survive the tough times that likely caused them to become cheap in the first place. This means examining things like the current ratio, current assets versus current liabilities, the overall debt percentage, and interest coverage ratios. Can they comfortably pay their debt interest? Financial strength provides the breathing room needed for a turnaround.
Okay, strong finances. What's third?
Third, seek companies with a leading position in industry. Even if the company is facing temporary problems, does it possess underlying strengths like strong brands, significant global demand for its products or services, or a clear sustainable cost advantage over competitors? The example given is BHP Billiton, a global mining giant. Even when commodity prices fluctuate, being a low-cost producer gives it a significant advantage and resilience.
So underlying quality matters, even when the stock is cheap.
Absolutely. Fourth, focus on forecasting the general direction of earnings, not precise estimates. We've already established how notoriously difficult and inaccurate precise earnings forecasts are. Instead of trying to guess earnings per share down to the penny, focus on the broader trend. Are earnings likely to stabilize, recover, or grow modestly from their currently depressed levels? This simpler, qualitative forecast has a much higher probability of being correct.
And
Finally, apply conservative earnings estimates. This goes back to Benjamin Graham's concept of a margin of safety. When you're evaluating a contrarian stock, deliberately recalibrate any earnings projections you use to lower more realistic levels, perhaps even to what Dreman calls a subterranean place. Build in a buffer for error and disappointment. Assume things might get worse before they get better.
can we see these strategies and indicators in action through some specific examples?
Yes, the book provides several. Philip Morris, now Altria and Philip Morris International, was recommended back in 2000 at around $23 a share, trading at a low PE of 8 times earnings. This was despite facing obvious and significant problems, namely massive tobacco litigation risk.
A classic out-of-favor situation.
Exactly, but the contrarian view was that the risks were potentially overblown and priced in. As the legal landscape gradually improved and became more predictable, the stock recovered strongly, more than doubling by 2008, along with paying hefty dividends. Another example is Apache Corporation, an oil and gas producer, recommended in 2005 at $65 with a PE of 11x. The contrarian insight was recognizing that global oil demand was likely to outstrip supply over the long term. The stock almost doubled by 2010, and BHP Billiton, the mining company, recommended in the depths of the financial crisis panic in late 2008 at $48. Despite widespread fears that industrial firms would take years to recover, the analysis focused on its status as a lowest-cost producer. Its earnings and cash flow bounced back strongly, the stock nearly doubled by 2010, and it continued raising dividends.
But it's important to acknowledge the setbacks too, right? It's not foolproof.
Absolutely critical to acknowledge that. Fannie Mae is presented as a clear strikeout. It had been considered a blue chip for generations. It was recommended in late 2007 at $37, with a low PE of 8x, partly because it seemed to have tightened its credit standards compared to subprime lenders.
But it got swept away anyway.
It got swept away by the sheer force of the systemic mortgage market collapse and ended up being taken over by the government. It demonstrates that even careful contrarian analysis based on historical strength and valuation can be overwhelmed by unforeseen systemic black swan type events. No strategy works 100% of the time, but the odds over time still favor the contrarian approach.
Okay, so we've covered individual stock selection. What about applying these ideas more broadly? Chapter 12 talks about contrarian strategies within industries.
Yes, this introduces Psychological Guideline 26, which offers an industry relative approach. The core idea is to extend the contrarian principle. Buy the least expensive stocks within an industry, as determined by the 4 contrarian strategies, low PE, PCF, PBC, high yield, regardless of how high or low the general price level of the industry group itself is.
So you can buy the cheapest tech stock, even if tech overall looks expensive, or the cheapest bank, even if financials seem risky.
Exactly. The rationale is that effect popularity and unpopularity drives mispricings within an industry group just as strongly as it does for the market as a whole. There will always be relatively favored and relatively unfavored stocks within any sector.
Yeah, the benefit of this approach.
The big benefit is diversification. It allows you to participate in virtually every major industry sector, spreading your risk, while still systematically tilting towards the undervalued stocks within each sector. This approach has also been shown to generate well above market returns.
How would you implement this practically? How do you know if a stock is cheap relative to its industry or the market?
It's fairly straightforward. You compare a company's key valuation ratio, its PE, PCF, PBV, and its dividend yield, not just to its direct competitors, but also to a broad market index like the S&P 500. As a rule of thumb, you might look for stocks trading at a significant discount, say 20% or more, on these value measures compared to the market average. Or for the yield strategy, look for a dividend yield that's at least 1% higher than the market's average yield. The deeper the discount relative to the market or industry average, the further into contrarian territory you're venturing, and potentially the greater the upside as that overreaction corrects over time.
The book uses a powerful analogy here, the market casino with unbeatable odds.
Yes, it's a great way to illustrate the statistical power of the approach. Using a Monte Carlo simulation, basically running thousands of random trials, they modeled playing a low PE strategy over 25 years. Imagine dealing 100 cards representing quarterly returns and playing this 10,000 times. The simulation showed that the low PE strategy beat the market 9,978 out of 10,000 times.
Those are incredible odds.
Almost unbeatable odds over the long run. If you rebalanced annually instead of quarterly, the odds improved even further to beating the market in 9,998 of 10,000 hands. Even for shorter periods, the odds are still strongly in your favor. 99% over 10 years, 94% over 5 years. And crucially, as Dreman points out, unlike a real casino where losing means empty pockets with contrarian investing, even underperforming the market in a given short period sends you away not with empty pockets, but with a large stack of chips. You're still likely making money, just perhaps less than the index temporarily. You're playing a game with a statistically proven positive edge over time.
But despite these superb returns and the compelling statistics, the human element still gets in the way, doesn't it?
It always does. We humans often get disappointed if the strategy doesn't win every single year, even if it wins hugely over the long term. As the book says, we demand the impossible and repeatedly make poor decisions in pursuit of the unattainable.
Chasing short-term perfection.
Exactly. Knowledge of these principles definitely helps, but our emotions, fear, greed, impatience, remain incredibly powerful forces, always threatening to pull us back into the old destructive habits of chasing fads and panicking at the lows. Discipline is key.
Okay, so we have these powerful contrarian tools, but we're operating in a rapidly changing environment. This leads us into the final section, Part V, the challenges and opportunities ahead. We begin with Chapter 13, Investing in a New Alien World, Navigating Modern Market Threats. The landscape feels different now, doesn't it?
It certainly does. The book acknowledges we're in an altered and unfamiliar investment environment. It's characterized by much higher volatility, sudden flash crashes, and the dominance of complex derivatives and high-speed trading that have left many conventional rules feeling, well, obsolete or at least challenged.
The flash crash of May 6, 2010 is cited as a stark example. What happened there?
That was a truly shocking event. The Dow Jones Industrial Average plummeted 9.2%, racing about $862 billion in market value in less than 10 minutes. It was unprecedented speed and magnitude. While the market did claw back some of the decline by the close, finishing down 3.2%, investor confidence was, as the book says, badly battered. It exposed a fragility many hadn't realized existed.
And high-frequency trading HFT was implicated.
Yes, the official SEC CFTC report pointed to HFT playing a major role in exacerbating the crash. It started with a single large automated sell order, a routine hedge, apparently for 75,000 S&P 500 mini-E contracts, valued at around $4.1 billion. This large order triggered a rapid burst of selling by HFT algorithms, which then crucially stopped buying and started selling futures themselves, acting as liquidity takers rather than providers. Other market makers also pulled back. This created a feedback loop, a vacuum of buyers, causing prices to cascade downwards incredibly rapidly. It demonstrated how fragile market liquidity could suddenly become in the age of algorithms.
And the chaos didn't stop there. We had the August 2011 panic, too.
Right, another period of extreme turmoil. The S&P 500 cratered following the U.S. debt downgrade and fears about European sovereign debt. The VIX index, the market's fear gauge, skyrocketed from a calm level around 16 up to 48 in just a matter of days. As the book states, panic was everywhere. Investors lost over $3 trillion domestically in less than 3 weeks. They pulled a massive $75 billion out of U.S. stock funds in just 4 months. Meanwhile, perceived safe havens like gold and near-zero yielding U.S. treasuries rocketed upwards as fear turned into pure contagion.
So what are the specific dangers of HFT highlighted?
Well, HFT itself isn't monolithic. It may be used for many dozens of trading strategies, some potentially beneficial for liquidity in normal times. But the danger arises in crises. In volatile periods, HFT traders use their enormous speed to accentuate market moves up or down, often withdrawing liquidity when it's needed most. Certain HFT practices like bid stuffing, where algorithms fire off and then instantly cancel thousands of buy or sell orders per second to create false impressions of demand or supply, are described as potentially very dangerous for market stability.
So regulation is needed.
Our sources strongly advocate for it. They argue that the prudent move to protect the large majority of investors would be to severely restrict HFT operations until these questions about their impact on stability can be answered. The speed advantage creates destabilizing risks that need managing.
Given this potentially alien world of investing, how can individual investors protect themselves?
Yeah.
What are the recommended protective actions?
Several practical steps are suggested. First, using exchange-traded and index funds, ETFs, makes a lot of sense for many investors. They offer broad diversification across markets or sectors with very low fees and transaction costs. For example, the XLF, an ETF tracking financial stocks, obviously got hammered, dropping 83% from its 2007 high. But for those who held on or bought near the bottom, it also rebounded strongly, up 158% from its 2009 low. ETFs provide easy access and diversification. Second, if you're looking for active management, focus on mutual funds that beat the market, but with very strict criteria. Seek funds with a proven 10-plus year record of outperformance after all fees and costs are deducted, and crucially, that are still run by the same manager responsible for that track record. Consistent alpha is rare. Third, for many, index funds remain a solid default choice. Funds like the Vanguard 500 Index Fund or the SPDR S&P 500 ETF provide market exposure with very low fees, ensuring you capture the market's return without manager risk or high costs.
What about investing internationally?
Fourth, consider foreign stocks, often accessible through ADRs, American Depository Receipts. These allow you to buy shares of foreign companies on U.S. exchanges. This offers geographic diversification and access to opportunities abroad, and these stocks can certainly fit into contrarian strategies. However, the key caveat is always be aware of exchange rate risk, as currency fluctuations can significantly impact your returns positively or negatively.
And finally, a crucial rule is about knowing when to sell.
Yes, this is vital. The guideline is sell a stock immediately if its long-term fundamentals deteriorate significantly. Note the emphasis, significantly. This isn't about reacting to temporary setbacks or bad quarters. It's about identifying major changes that weaken a company's long-term prospects, a broken business model, lost competitive advantage, overwhelming debt. In such cases, taking losses early usually results in the smallest loss compared to hoping things will magically turn around.
This discussion of risk leads naturally into Chapter 14, toward a better theory of risk, beyond volatility. We've already seen how the old paradigm, defining risks solely as beta or volatility, failed spectacularly.
Exactly. The untested economic theory of risk, based purely on volatility, collides head-on with affect research findings about risk behavior. Remember, affect research shows that perceived risk and perceived benefits are often negatively correlated in our minds, the opposite of what KPM assumed. This reveals a fundamental misunderstanding in traditional finance about how people actually perceive and react to risk.
And the traditional view ignored key risk elements that have caused damage for centuries.
Yes, several critical risk factors were downplayed or ignored by EMH-DPM, yet they have repeatedly proven disastrous. First, lax lending standards. History shows again and again that periods of abundant monetary availability and low interest rates inevitably lead banks and other lenders to ease their standards, chasing yield and making riskier loans. We saw this clearly with subprime mortgages leading up to 2008, but also in commercial real estate bubbles in the 1980s and 1990s. The repeal of the Glass-Steagall Act in 1999, which had separated commercial and investment banking, is also cited as exacerbating liquidity and leverage problems in the run-up to the crisis. Regulation matters for managing systemic risk. Second, the flawed assumption that liquidity does not beget liquidity. EMH implicitly assumes that as prices fall, swarms of buyers will appear, ensuring market liquidity.
But real-world crashes show the opposite.
Exactly. Evidence from the 1987 crash, the 2010 flash crash, and the 2011 panic clearly shows that in times of severe stress, liquidity can decrease sharply or even dry up almost completely. Buyers disappear precisely when sellers need them most. Relying on continuous liquidity is dangerous. Third, leverage, the second horseman of the financial apocalypse, alongside illiquidity. Using high amounts of borrowed money, margin or leverage, is identified as a major cause of crashes. When high leverage combines with sudden illiquidity, as happened in 1987, 2007, 2008, and with LTCM, the results are disastrous. Forced selling into an illiquid market creates a vicious downward spiral, which leads to Psychological Guideline 29.
It warns.
Leverage is a risk that the conservative investor should avoid. It magnifies both gains and, more dangerously, losses.
So how can investors protect themselves against these often ignored risks of illiquidity and leverage?
Several practical pieces of advice are offered. First, avoid unregulated, opaque financial products like many hedge funds or private equity funds, especially those that lack a long track record, offer limited liquidity, lockup periods, and charge very high fees. The lack of transparency is itself a risk. Second, be deeply wary of chasing 100 baggers, those speculative, high-growth startup stories often accompanied by wildly inflated promises and valuations. The failure rate is extremely high. Third, exercise caution with little-traded issues, stocks that have very low trading volume. Ensure there are active market makers providing liquidity, and keep your position size small relative to the daily volume so you can get out if needed without crashing the price. Fourth, steer clear of complex, exotic derivatives unless you truly understand them inside and out, which few people do.
And the overarching principle.
Perhaps the most important piece of advice. If you don't understand a bond or a hedge fund or any other security, don't buy it. Simplicity, transparency, and understanding are your best allies in managing risk. Don't invest in things you can't explain.
Now, despite all these market risk and psychological pitfalls, the book makes a strong case that, over the long term, stocks are the least risky investment. How can that be?
It sounds counterintuitive, especially after discussing crashes, but it comes down to the impact of inflation and taxes over long holding periods. Historical data consistently shows that stocks significantly outperform safer-seeming investments like government bonds and treasury bills over longer time horizons, after accounting for inflation eroding purchasing power and taxes taking a bite out of returns. The probabilities shift dramatically with time. After holding for just 4 years, stocks historically had about a 73% chance of beating bonds and a 77% chance of beating T-bills on an inflation-adjusted basis.
What over longer periods?
After holding for 15 years, the probability of stocks outperforming both bonds and T-bills surged to almost 100% based on historical data going back decades. The compounding growth of equities eventually overcomes short-term volatility. This is reinforced by Psychological Guidelines 34A and B.
What do they say?
They state, A, inflation and taxes sharply reduce your risk in owning stocks over longer periods. And conversely, B, inflation and taxes sharply increase your risk in owning treasuries, other bonds, and savings accounts over longer periods. Inflation is the silent killer of fixed income returns.
So this suggests a completely different framework for thinking about risk.
Yes, a new risk framework focused not just on short-term volatility, but on the probability of capital preservation, keeping pace with inflation, and outperforming alternatives over your specific intended investment horizon. For example, for a 30-year-old investor aiming for retirement at age 65, a 35-year horizon, investing consistently in a diversified portfolio of blue-chip stocks historically offered close to a 100% chance of both enhancing your capital after inflation and taxes and outperforming bonds and T-bills. The biggest risk for a long-term investor isn't volatility, it's failing to grow purchasing power.
Which ties into Richard Thaler's wisdom.
Exactly. Richard Thaler, a Nobel laureate and pioneer of behavioral finance, wisely wished that stock quotes were not published every day. Why? Because overexposure, particularly in bad times, precipitates hasty and often foolish decisions based on short-term noise. He suggested investors should try to treat their stock investments more like they treat their real estate, focusing on the long-term value and fundamentals, not obsessing over daily price fluctuations.
Okay, we've covered the psychological traps, the flawed theories, the power of contrarianism, and a new view of risk. Let's wrap up with the final chapters in Part V, starting with Chapter 15. They're gambling with your money, the not-so-invisible hand in action. This invokes Adam Smith's invisible hand, the idea that individual self-interest in a free market can lead to collective good. But Smith himself had warnings, didn't he?
He absolutely did. While Smith championed the benefits of free markets, he also explicitly warned about the dangers of collusion of business and industry against consumers, and how powerful private interests could promote their own self-interest by influencing politics and legislation. This creates a very visible, often self-serving hand rather than an invisible, benevolent one.
And the book points to the Greenspan legacy as a modern example.
Yes, Alan Greenspan's tenure as Federal Reserve Chairman for almost 20 years is presented as a case study. He held an almost unshakable belief in the power of market self-regulation. Consequently, he actively lessened the regulation of derivatives and consistently opposed stronger oversight of the financial industry, convinced that sophisticated financial institutions would, in their own self-interest, regulate themselves well to avoid excessive risk.
How did that work out?
Not well, according to the analysis. His tenure saw two major market crashes, the end of the dot-com bubble in 2002, though the '87 crash also happened early in his term. And his policies are seen as playing a major role in inflating the 2002-2006 housing bubble that led directly to the catastrophic 2007-2008 global financial crisis. Despite mounting evidence of problems, Greenspan and his successor, Ben Bernanke, continued to issue reassuring public statements, like Bernanke's infamous March 2007 claim that the subprime fallout was likely to be contained. The belief in self-regulation proved tragically misplaced.
The system was also being actively gamed, particularly by the credit rating agencies, CRAs.
Yes. The book highlights how the CRAs, primarily Standard & Poor's, S&P, Moody's, and Fitch, fundamentally undermined their own credibility and gamed the system. Historically, CRAs were paid by investors seeking objective ratings, but the system shifted to an issuer pays model, where the banks and companies creating complex securities paid the agencies to rate them. This created a massive conflict of interest.
Because the agencies wanted repeat business from the issuers.
Exactly. They were incentivized to give favorable ratings to win lucrative deals. This led directly to the absurdity of AAA ratings, the highest level of safety being stamped on what the source bluntly calls subprime trash, like complex residential mortgage-backed securities, RMBS, and collateralized debt obligations, CDOs, stuffed with risky loans. S&P's own revenues from rating these structured finance products more than tripled between 2002 and 2007, showing how profitable this flawed system was for them. The ultimate absurdity cited was S&P giving a AAA rating to a deal backed by subprime auto loans in 2011, shortly after it had controversially downgraded the sovereign debt of the United States itself.
So bankers could sell risky products with a fake seal of approval.
Precisely. Investment bankers could create these toxic mortgages, package them into complex securities, get a falsely high credit rating slapped on them, and then sell them with high yields to unsuspecting investors, like pension funds and foreign institutions, who relied on those ratings. They further amplified the risk by using off-balance sheet vehicles like SIVs, structured investment vehicles, leveraged 30 to 35 times the amount of their capital. It was a ticking time bomb built on compromised ratings.
And Goldman Sachs is singled out for its actions during this period, the ginormous credits.
Yes, Goldman Sachs's actions are detailed as a prime example of the ethical failings. They, along with a syndicate of other bankers, created complex synthetic CDOs. Through credit default swaps, CDS, they effectively allowed clients like the hedge fund Paulson & Co. to short bet against bundles of mainly AAA-rated subprime mortgages. Goldman was on the other side of many of these trades, often selling protection through AIG financial products. This exposure eventually led to AIG's near bankruptcy and required a massive $62 billion taxpayer bailout channeled through the New York Fed, much of which flowed straight to Goldman and other counterparties.
And they were selling these toxic assets to clients while betting against them.
That's the most damning part. As the subprime market clearly started to crumble in early 2007, internal emails show Goldman executives recognized the danger, yet the firm moved quickly to increase the sale of its toxic inventory to clients. Internal emails referred to deals they were selling as shitty, while simultaneously offering their sales force ginormous credits, bonuses, to push these products out the door.
What happened to the investors who bought them?
These highly rated securities were very quickly downgraded to low junk ratings as the crisis unfolded, and investors who bought them lost most or all of their capital. The book argues this represented a profound breach of ethics, stating that Goldman and others sold tens of billions of dollars worth of low-quality mortgage-backed securities to their own clients, while simultaneously believing the market was collapsing, fundamentally breaching their fiduciary duty to act in their clients' best interest. It showcases how unchecked self-interest and compromised systems can override ethical responsibilities and market integrity.
Okay, moving to the final chapter, chapter 16, the not-so-invisible hand, global economic challenges. This broadens the scope beyond just finance.
Yes, it looks at how these dynamics play out on a global scale, starting with the concept of free trade. Adam Smith's 18th century vision, further developed by David Ricardo in the 19th century, is argued to be largely an economic myth in today's world. The reality, according to the source, is that most nations practice fair trade, meaning managed trade with tariffs, quotas, and subsidies, rather than truly free trade.
And the challenge today is globalization of labor.
Precisely. The rise of highly skilled labor pools and advanced technology in very low-wage countries, particularly China and India, has dramatically lowered global production costs for many goods. The book contrasts the average U.S. hourly pay, around $22.90, including benefits at the time, with China's closer to $2. This vast differential puts higher-wage countries such as the United States at an enormous disadvantage in direct competition for manufacturing and, increasingly, service jobs. The potential consequence highlighted is that this could force policies that intentionally lower our standard of living in developed nations, things like reducing social safety nets, or austerity measures affecting public sector jobs like teachers and police.
China's specific role is highlighted as particularly challenging.
Yes, several issues are raised concerning China's trade practices. One is the blatant disregard for intellectual property, IP rights, with industrial piracy and counterfeiting of software, pharmaceuticals, and branded goods running into tens of billions of dollars a year. The example given is that perhaps 80% of Microsoft Windows copies used in China were pirated. Counterfeiting of physical goods originating from China was estimated at a staggering $480 billion annually, with much of that impacting the U.S. That figure alone was 75% larger than the entire U.S. trade deficit to China at the time. Currency manipulation is another major point. China's past refusal to allow the value of its currency, the yuan, to float freely and appreciate was seen as artificially keeping its exports cheap and imports expensive, further distorting global trade balances to its advantage.
And the consequence for the U.S. workforce.
The consequence cited is a severe job shortfall in the U.S. The book states that no new net jobs have been created domestically over the preceding 10 years, relative to when it was written. U.S.-China trade alone was estimated to have eliminated or displaced around 2.8 million American jobs during that period. The concern expressed is that the accelerating trend of outsourcing U.S. jobs abroad is showing no sign of abating, hollowing out the domestic industrial base.
But the outlook isn't entirely hopeless. There's a path forward.
The book argues there is. The U.S. still possesses significant advantages: abundant natural resources, a strong, though diminished manufacturing base, technological leadership, and strong universities. The proposed path forward is for the U.S. to essentially play the trade game the way most countries do. This means expanding and improving its negotiation capabilities and using leverage to force countries running large trade surpluses, like China, to genuinely open their important but often restricted domestic markets to U.S. goods and services. It's a call for more assertive, fair trade policies.
Finally, this complex global picture leads to a discussion about the case for future inflation.
Yes, the book concludes with a strong warning about inflation risks, stemming from the response to the financial crisis. It bluntly calls the Great Recession a euphemism, stating it was effectively the second worst depression in the nation's history. The policy response involved massive government budget deficits running at $1.3 to $1.4 trillion annually in the U.S. from 2009-2011, coupled with trillions more in bank bailouts and unprecedented monetary stimulus like quantitative easing from the Federal Reserve and central banks worldwide. In essence, money is being printed on a worldwide basis on an enormous scale.
And the predicted consequence.
The prediction made at the time was for serious inflation within 2 to 5 years, potentially reaching levels as bad as what the nation went through from 1978 through 1982, a period of very high inflation. This projected inflation would cause sharp losses to treasuries, T-bills, and other fixed income securities, eroding their value significantly. There was also concern that the Fed's continued loosening of credit could fuel new destabilizing asset bubbles abroad as cheap money chased higher returns elsewhere. The overarching conclusion is that understanding these large-scale economic challenges alongside the inherent psychological flaws driving market behavior is absolutely crucial. But for those who understand the resulting overreactions, solid contrarian investments offer a way to potentially harness it for profit, even amidst the uncertainty.
And there you have it. Wow. We've certainly covered a lot of ground today. We've journeyed from those deep psychological currents effect, heuristics that drive irrational bubbles and flawed decisions, through the deconstruction of seemingly unassailable economic theories like the efficient market hypothesis, and landed in the practical, data-backed world of contrarian investing.
Absolutely. And the crucial takeaway here, I think, for you, the listener, is that this understanding of how the market truly works, driven far more by predictable, often emotional human behavior rather than perfect mathematical rationality, is potentially your most powerful tool as an investor. It's not about finding some magic bullet or predicting the future perfectly. It's about understanding the odds, recognizing the patterns of overreaction, and using that insight to tilt the probabilities in your favor. It gives you a distinct advantage if you have the discipline to apply it.
Exactly. We've seen throughout this deep dive that the human element, with all its inherent biases and emotions, actually makes markets behave in remarkably predictable, albeit often irrational ways. This predictability, once you understand its psychological roots, isn't necessarily a threat. It's actually an immense opportunity. So as you navigate your own financial future, the question becomes, will you fall prey to the same historical patterns of overreaction, flawed thinking, and chasing the crowd that have always plagued investors? Or, armed with this knowledge, will you have the courage and discipline to embrace the contrarian path, to look for value where others only see problems, and potentially find profit where others only see panic? The choice and the potential opportunity is ultimately yours.